Now in today's video, we're going to dig deep into a topic that a lot of newer investors are probably very interested into, and we're talking about higher yielding dividend stocks and ETFs. Now these higher yielders are obviously very attractive because they give the allure for a lot more cash flow a lot sooner, which especially for me as an early investor, I was definitely drawn towards just because earning dividend income consistently has always been on the top of mind when it comes to my investing journey. Now there's a common belief out there that just because a stock or ETF offers a much higher yield, that it's automatically dangerous, that it's automatically going to underperform lower yielding alternatives, etc. And of course, that's a dividend trap waiting to happen. We've all heard of that too. But that's just not the whole truth. In fact, higher yielding instruments, like some of the ones we're going to talk about in today's video, can be just as powerful as lower yielding tools for your portfolio. So if you want to go through with me and break down why higher yielding stocks and ETFs are not inherently dangerous, and in fact they can often be very helpful depending on what your strategy is for your long-term portfolio. Well, then make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey, and my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now first, let's talk about something that's very important. It's important that we realize that saying that something is high yield is dangerous, that is an oversimplification of whatever stock or ETF we're talking about. High yield does of course come with some risk, but it's not like it's binary. Just because something is higher yield or lower yield does not mean that it's either good or bad or vice versa. It's better to look at yield, whether it's high or low yield, as just one single data point. You really shouldn't be looking at something whether it's low yield or high yield and think that you can overall rate the safety or the benefits of that investment just based off that alone. Now, high yield can be the results of many different things, such as a company's financial health, interest rate environments, market sentiment, or of course, income strategies employed by the fund or company. Now, this brings me into a great example of a higher yielding ETF that I'm talking about names like JPIE or even QQQY, two of my personal favorite holdings in my long-term portfolio. These ETFs hold baskets of stocks, often lots of tech and growth names inside there. They don't just sit on those names and collect dividends and see some potential upside, but instead they utilize option strategies, which generates a lot more income by collecting premiums from option buyers, for example. Now, because option premiums are tied to implied volatility or IV, a fancy way of saying how much the market expects a single stock's price to move either up or down, these ETFs can earn consistent income like a lot of them have and offer very high yields, even if the stocks don't pay massive dividends themselves. Now, the two names JPIE and QQQY, for example, allow me to earn somewhere around 12 to 14% annually just from yield alone. But again, this is not necessarily dangerous. This is because of the strategy that these ETFs use, which is just one of many examples where a higher yielding asset is not necessarily risky or dangerous. Now, even though some of those higher yielding instruments, like the ones we talked about just a second ago, do often offer a consistent payout, which has been pretty good since inception, it doesn't mean that they come without their own risks. Even these option ETFs do have market risk. I mean, they can lose value, they could even drop their payouts, etc. But the key takeaway is that high yield is not automatically a red flag like a lot of investors try to teach you early on. You have to understand, where does this yield come from? Is this a single stock that's paying a high yield, paying out more than the company's even earning? Or is this an ETF that utilizes an option strategy that buys into single stocks that have relatively high IV? Now, the real danger when it comes to high yield is something that I definitely did in my early days of investing, and this is just chasing high yielding stocks and ETFs blindly. Just going through a list of stocks and ETFs, sorting them from highest yield to lowest yield, and just blindly spending your hard-earned money on some of the highest yielders because you're hoping for juicy payouts every single quarter or every single month. Now, this can lead you down a dark path full of different dividend cuts, falling prices, NAV decay, all the things that you honestly should be worried about. So always look into things like dividend payout ratios, look into debt levels if you're talking about a single stock, and of course look into fund strategies, which is basically all I talk about here on the channel, and understand how these funds work, and if they are paying a massive high yield, understand how they're paying that massive high yield. So just to wrap things up, higher yielding dividend stocks and ETFs, like I shared with you guys, are not necessarily inherently dangerous. It really depends on underlying factors. It depends on the strategies, specifically when talking about different ETFs that offer 10%, 20%, or even upwards of 30-40% yield. Now, again, I think it's safe to say that if you're talking about names that offer an insane yield, there probably is going to be a decent amount of risk involved with it. But just because an S&P 500 or NASDAQ 100 option income ETF like SPYI or QQQI, for example, offer a 12% or 14% yield, don't mean that they're necessarily dangerous, quote unquote. So now that I gave you guys a decent idea of why high yield dividend stocks and ETFs are not dangerous necessarily, I shared with you guys why some actually are, but how a lot of them actually aren't. I want to hear from you guys now down below. When it comes to your investing strategy, are you generally looking for higher yielding names with a little bit more income potential or lower yielding names with much more growth? Let me know in the comments down below. If you guys enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.